And if you would be so kind to mute your microphone and add any questions you have to the chat, and I will do my best to keep notes of those for us today and get those over to Tom during our question and answer section of this presentation. For those of you that are not familiar with Zoom, at the bottom of your screen, you will see a menu that has your little microphone where you can mute, you can be on camera or off, whatever you feel comfortable with today. As well as you can see a list of the participants. The chat box is there. It looks almost like a little cartoon bubble, as well as an opportunity for closed captioning if that is something that you would like to have this morning. We will be sending out the recording after the presentation, so we'll stand by for that, as well as any resources that Tom shares with us today. All right, so the SBDC is funded in part through a cooperative agreement with the U.S. Small Business Administration and is supported by America's SBDC, the Virginia SBDC, Mason Enterprise Center, Go Virginia, local organizations and government offices, as well as businesses who help provide matching funds. Our host, who serves as our fiscal agent in Roanoke, is the Roanoke Regional Chamber of Commerce, which is actually where our headquarters is on the first floor of that building. We in the Roanoke Regional SBDC currently serve the greater Roanoke area, Allegheny, and the New River Valley, excuse me. The Roanoke Regional SBDC is a part of the Virginia SBDC network. We are one of the 27 centers located across the state of Virginia, and the little triangles denote, and generally speaking, where the different centers are located. So if you're not in the greater Roanoke area, I will add a link to our chat where you can click on that to connect to the SBDC that is closest to your business location. We welcome to connect with you through our website. We've got lots of great resources and information there. I'll also post that in the chat as well. You can always reach back out to us through email at hello@roanokesmallbusiness.org, as well as by phone that works for call and text. And then you can also reach us through social media, through Instagram, Facebook, and YouTube. So feel free to reach out to us. We are here to help you if you need to be connected to another center. Don't hesitate to reach out. That information comes to me and I'll help direct you to the right folks where you need to get connected to. All right, and the moment we've all been waiting for, to hear from Tom Tanner, who is our host this morning. He is our lead advisor and Vet Biz coordinator. And we're so excited to have Tom and looking forward to hearing his presentation today about employee retention credits. All right, Tom, take it away. I'm going to stop sharing and so you can share your screen. And for those of you that are just joining us, if you want to have not taken the poll, I think Tom's going to give us maybe one more minute to add that. And then if you will also add to the chat, if you feel so inclined to add your name, the name of your business, as well as where your business is located and how you're showing up today.
All right.
Turn it over to you.
Good morning, everyone. I guess everybody can hear me. All right. You can see my screen. All right. I'm on a roll. Yeah, I'll give you another 30 seconds to fill out this survey while I go through my disclaimer. Basically, what I've done is look through what's available as of today. I've made my best efforts to provide and properly interpret the information. Of course, the SBA, IRS, the government can make changes at any time. So if you're interested in taking advantage of this program, you certainly want to check with your accountant or even attorney to make sure there's any issues or the latest before you actually take advantage of it. I also include some references to the IRS notices that go in a little bit more detail about this program. All right. Yes, ma'am.
We can see it's on the presenter view for your slides.
It is. That means I picked the wrong screen, huh?
That's okay.
All right, let's try this again. I got like 3 screens going. How about that one?
Perfect.
All right.
Thank you.
So I'm going to stop this poll and let everybody take a look at it unless anybody wants the last second. So it looks like some of you have heard of it. Some are familiar, but nobody's really familiar with it. And of course, there's a couple other things I threw in there just to see what's affecting people now. And it looks like access to capital and certainly some ongoing impacts of COVID. And this last thing, which I'm going to just briefly talk about, which is this paid sick and family leave credit. Very few people have heard about that either. So anyway, I'm going to stop my sharing, close this out, and get started. All right. So the first thing I want to talk about is just some quick facts about the employee retention credit. And some of you may have already been through this class before. I've done this class multiple times. The simple reason is I can't seem to get the message out to everybody because still less than 15% of small businesses are taking advantage of this particular credit. So, and a lot of that is because more than 50% of accountants haven't even filed any ERC credits. So I don't know if the issue is the accountants aren't asking clients aren't asking the accountants, or nobody knows enough about it to make a decision. So hopefully after this class, and if you qualify, obviously, if you qualify, you need to go forward and talk to whoever can help you fill out the proper forms. The biggest thing is that startup businesses also qualify under certain circumstances. And we'll go into detail about that, but this is a big deal that a lot of people are also not aware of. And that you can go back to the second quarter of 2020, even 2020 is over with, there's no reason you can't go back and reclaim credits from the previous year. It does affect a few things, like if you do get a credit in 2020, you may have to file an amended tax return, but if you get enough money back, filing an amended tax return is insignificant. The program did end on September 30th. That's a recent change. It was running till December 31st because of the latest infrastructure bill that was passed. They took away the fourth quarter of the program. Now, if you're a startup business which they call recovery startup business, you are still eligible for the fourth quarter. All right, so basically what is the ERC? Basically provides a tax credit for any business that experiences any of the following. And again, I'm only going to be talking about businesses that have less than 100 employees because I figure that's mostly what is on this particular conversation. If you have more than 100 employees, there's different rules that you need to follow. So one is your business was fully or partially suspended in 2020 due to government saying you need to close down, or you can't travel, or you can't have group meetings, et cetera, or it was because your business had more than a 50% decline in gross receipts for a quarter in 2020 versus the same quarter in 2019. So this applies to both a for-profit and a nonprofit operation. It is not available for self-employed unless you have employees. And then it's only good for the employees, not the owner. So we want to point that out. Is available in this initially when this program came out in 2020, they basically stated is if you received a PPP or EIDL, you could not qualify for the ERC. That was changed, and even if you received a PPP and RRF and EIDL or SBOG or any of these acronyms, you can still receive an ERC. There's some qualifications which we'll talk about later on. So let's first talk about what is the 2020 whoops, how do I get on this one? The 2020 ERC. Okay. So what's the 2020 ERC? So this provides a tax credit for any business that experienced any of the following. Again, we talked about the business being partially suspended in 2020, government shutdown, et cetera, or had more than 50% of funds. Okay. So let's go to the 2021, which is a little different. provides a tax credit for any business that experienced any of the following. Again, this is 2021 versus 2020. Again, your business was fully or partially suspended in 2020 due to orders from a government agency limiting commerce, travel, meetings, et cetera, or the big change was you had more than a 20% decline rather than a 50% decline. So you only had to have a 20% decline to take advantage of the ERC in 2021. And again, this is comparing 2021 to 2019, not to 2020. And the same thing applies, can be a for-profit, nonprofit. It doesn't apply to the self-employed. All right, so this is the big change that certainly is available for businesses who started up. So if you started after 2/15 of 2020, you are considered a recovery startup business. And what they mean by started after 2/15 is that you're actually have a going concern, you're doing business, you're taking in income, et cetera, et cetera. It doesn't mean that you set up an LLC. So if you set up an LLC in January, but you didn't really open the doors until 2/17 or 2/18, then you qualify for this program. So don't let the fact that you said, hey, I got my business license in January. I set up my LLC and got my business license in January, but I really didn't start doing work until late February or March, then you do qualify as a recovery startup business. And again, it's only available for the third and fourth quarter of 2021. Really, the only qualification is that you didn't have $1 million in sales in 2020 or 2021 for the calendar year. If you did, you wouldn't qualify. But if you didn't, then you would qualify, because there's no requirement for decreased sales like the other one, where 2020 was a 50% decline, 2021 is a 20% decline. There's no decreased sales requirements. And for some reason, if your business is large enough and you did have some sort of decline and you actually qualify for the ERC, you can still file for a regular ERC and not use this program. But for 99% of you, you're probably going to use this particular program. And what it does, it covers 70% of all wages up to $10,000 per employee per quarter. So if you have one employee making $10,000 in a quarter, you'll receive a credit of $7,000. If you have two, you'll receive $14,000, and that's per quarter. So for third and fourth quarter, you would be doubling that. So if you had $20,000 for employee in third and fourth quarter, you would receive $14,000 just for that one employee. Now, the only limitation is the maximum amount a company can claim is $50,000 per quarter, or $100,000 total. Still nothing to sneeze about. So that's a pretty good deal. And again, this is a big deal since a lot of businesses, since businesses who started up after 2/15, most of you did not qualify for PPP or EIDL or anything else. So this is a great program to take advantage of that. And if you're a nonprofit, you can also apply for this. So we're going to talk about a little bit about definitions. So gross receipts. So really, the gross receipts of what we're talking about is really net returns, net returns or allowances. Really, it's the same thing that's going to show up on your federal tax return. It's total sales. It's not going to include any of these other things like PPP loans, EIDL advances, restaurant revitalization funds, shuttered venue grants. But it might include local and state grants, because many of the local and state grants would be taxable income. So if you're a nonprofit, I'm not going to cover that, but you'll get a copy of this presentation. You can go through and see exactly how a nonprofit would cover for this. I'm also not going to talk about this, but just let you know, if you're a company that owns multiple companies run by the same owners, you need to see the aggregation rules because they are not necessarily complex, but certainly there's some details about it. So how is the 50% decline determined for 2020? Because remember, you had to have at least a 50% decline in 2020. So basically what you're doing is you're looking at gross revenue for a quarter compared to the same quarter in 2019. So if you look at the first quarter, well, let's just take this first quarter is probably not going to apply. Let's look at the second quarter of 2020. How did it compare to the second quarter of 2019? If your revenue was down by more than 50%, then you would qualify for that. And once you qualify for that program, once you fall below that 50%, you qualify, you can continue to qualify for that program until your quarterly revenue has reached 80%. Once you get above 80% back to your 2019 levels, then you would drop out of the program. And I'll have examples going forward that will make a little bit more sense of this. So how was determined for 2021? Again, the program runs from January 1st to September 30th. So again, if revenue in any quarter of 2021 is less than 80% of the same quarter in 2019, again, we're comparing to 2019, we're not comparing to 2020. Under certain circumstances, you may compare to certain quarters, but for most cases, you're going back to 2019. Such as the business was not in operation for comparable quarter of 2019, then you would use a comparable quarter of 2020. So if you weren't in business in the first quarter of 2019, but you were in the second quarter of 2019, then you would compare the first quarter of 2021 to the first quarter of 2020. There is an alternative quarter that you can select a preceding quarter. I'm not going to go into that because it's complicated, and this is a question you probably just want to ask your accountant. Again, the credit will continue until your quarterly revenue has reached 80% compared to the same quarter in 2019. Again, just like the 2021 is if you drop below 80%, then you qualify for the program, and you'll continue to qualify until your quarterly revenue has reached 80%. So if you're 75%, as soon as you get to 80%, then you're no longer qualified for that quarter. So what is the amount of credit? So let's look at 2020 first. So it's equal to 50% of the qualified wages paid to an eligible employee during the covered period. Okay, so basically, if they have a certain amount of wages, you'll get reimbursed for 50% of it. There's some qualifications that we're going to talk about. And qualified wages include your healthcare insurance paid by the employer and premiums that the employee might have paid with pre-tax dollars. So the maximum amount of qualified wages that you can claim credit for is $10,000 or a maximum of $5,000 credit per employee for the year. So once an employee has reached $10,000 of wages for that entire quarter, for the entire year, all of 2020, then that person has been maxed out for their credit. And of course, you can cross over to multiple quarters. Again, I'll show you an example that makes that a little bit more easy to understand. So even if the employee is still working, then that person would qualify. So this is the difference between having less than 100 employees and having more than 100 employees. If you're less than 100 employees, you could still have the person working and paying a person, and you would qualify for that credit. If you have more than 100 employees, then you would have to have been paying your employee to stay home, okay, rather than go file for unemployment or whatever else. And the covered period is from March 13th to December 13th of 2020. So let's look at 2021 because that's a big deal now. So it's equal to 70% of qualified wages paid to an employee during the covered period. And even better than that, the maximum amount is again $10,000, but it's a maximum of $7,000 per quarter per employee per quarter. So instead of the 2020 credit, where once the employee reaches $10,000 for the year, they are maxed out. For 2021, they can max out each quarter so that you can get multiple. So if you qualify for 3 quarters and you had just one person and they made $10,000 a quarter, you could actually get a $21,000 credit. So that's why this is the 2021 is a big deal compared to 2020. Again, the same thing, even if the employees are still working, you can claim the credit. Same thing about including healthcare insurance, et cetera, et cetera. Again, the covered periods from January 1st to September 30th. Again, it's only for first, second, and third quarter. So I put together this little chart, and again, I'll be sending all of this out to everybody, but you can look at it and say, okay, what particular program? So let's say you were using the PPP program. So we have round 1, which was 2020. You have round 2, which was 2021, and round 3, which is the third quarter of 2021. And it basically says yes, but not for the same wages. In other words, if you had a PPP or EIDL, RRF or SVOL, you cannot use the same credit as you did for the PPP. And again, I'll show you an example of that in a minute. In other words, you can't double dip the credits. Round 1, you'll see the eligible wage base with $10,000 per employee. The credit amount is 50, and the max amount of credit is 5,000 per employee for a year. In round 2, which is the first and second quarter of 2021, it's $10,000 per employee with a 70% credit, or $7,000 per employee per quarter. Round 3 is the same thing. And also at the very bottom, you'll see the recovery startup business is only available for third and fourth quarter, but it's $7,000 per employee for both the fourth and third quarter, with a $50,000 maximum per quarter, $100,000 total. All right, so let me give you an example of how this whole program works. We're going to look at 2020 first. So we're going to say, look at quarter 1. And for 99% of everybody, quarter 1 is probably not going to apply for the simple reason that most of you weren't shut down. The program didn't even start till March 15th. So I'm just using an example is 2019 gross receipts versus 2020. You were at 93%. So no, that was not an eligible quarter. That's not surprising. Okay. Quarter 2, you had gross receipts of $40,000 in 2019, but in 2020, you dropped all the way back down to $18,000, which is probably not surprising for many of you businesses. Probably a lot of you dropped even farther than that. So if you compare the two, you had a 45, you were doing 45% of what you did in 2019, which means you now qualify for the second quarter. Okay. Now we're going to move to the third quarter, and you had gross receipts in 2019 of 50. Your gross receipts in 2020 went to 40. So now you're back at 80%. Which means now you're kicked out of the program. But even though you're kicked out of the program, you're still allowed to claim the third quarter because that's the quarter that you went out of the program. And then fourth quarter, you would not be eligible for it unless you drop back down below 50% again. Okay, so now let's move to the 2021 example. So we're looking at first quarter, second quarter, and third quarter. So first quarter, you had $30,000 in 2019. In 2021, you only had 22.5, which means you were only doing 75%. So you are eligible for that particular quarter. Again, quarter two, you were at 40, gross receipts were 33. So now you're back above 80%, which means you still qualify for that particular quarter, but you're not going to qualify for the next quarter unless you reach below 80% in the third quarter. So that's the way that works. Hopefully that's pretty self-explanatory. So let's look at some math now to kind of show you how this credit works. And I'm making the assumption that this particular business qualified for all 3 quarters. So that, qualified for all 3 quarters. So let's look at each employee. We got employee 1, employee 2, and employee 3. So employee 1 was paid $15,000 in quarter 2. So he's able to claim up to $10,000 per employee for the year. So he's going to claim that entire $10,000 for that employee. Okay, in quarter 3, that employee was paid $15,000, but they've already used up their $10,000. So there's no qualified wages for that person in quarter 3 and quarter 4. So now let's look at employee 2. They had wages of $6,000 in quarter 2. So they have qualified wages of 6, which means they've still got $4,000 left over, which you'll see they used in qualifying wages in quarter 3. Qualified wages in 4 would be 0 because they've now used up their $10,000. And for the third employee, they never reached $10,000. So they had $3,000, $3,000, $3,000. So they had $9,000. So he still had an extra $1,000 of qualified wages if they wanted to use it. So if you add all those things up, they basically have $29,000 worth of qualified wages for those 3 employees for second, third, and fourth quarter. So if you take a 50% credit, you would get a $14,500 credit for this particular 2020. All right, so let's jump to 2021. And again, we're assuming you're qualified for all 3 quarters. So again, the same employee, $15,000, they qualify wages of 10. So now in quarter 2, it's reset again. So this person had $15,000 in wages. So they now qualify for $10,000 again. In quarter 3, he only made $8,000, but he qualifies for the entire $8,000. Okay, same thing with employee 2. All their wages are qualified because it resets each month back to 10. The same thing with employee 3. Okay, so if we add all of those up, we're at $58,000 in qualified wages. And if you take 70% of that, then this particular this particular business would receive a refund credit for $40,600. All right, so we're going to now move to the recovery startup business. Again, this is only for third and fourth quarter of 2021, but this is if a business started after 2/15, which means they started on 2/16. Okay, so let's look at wages paid in quarter 3 of this particular employee 1 at 15. Their qualified wages is 10. The same thing for wages for fourth quarter. Qualified wages at 10, and you can see how it runs across each month. Each person is qualified up to $10,000. So if you add all those up, this particular company would have a $40,000 payroll during those particular quarters. So therefore, they would receive a $28,000 credit. Pretty cool. So some of the issues that we had talked about. So if you receive CARES funds, and again, that's any of these here, you cannot use the same money to claim an ERC that you use for the same payroll. And I'll give you an example here in a second. The other thing, payroll used for ERC credits are not deductible. So if you remember, if you've got a PPP or some of these other programs, If in fact that you had it forgiven, remember that you didn't have to include the income, but you could include the expense on your income tax return. So you're, under that particular program, you're really double dipping. For the ERC, you cannot take the, you don't have to count the income, but you are not allowed to also take the deduction. They also, the IRS basically said, okay, if we're going to go through and make all these fabulous changes to ERC, then there's also going to be a statute of limitation for 5 years for being audited. So rather than the normal 3 years. So just keep that in fact, that if you're taking advantage of this program, make sure you're keeping all your payroll documentation, everything you did use to figure this math for at least 5 years in the event you are audited. There is also one other qualification for certain types of business. This is a severely financially distressed employee that had a decline of 90% or more. There's in those cases, all wages are considered. All right, so let's look at this PPP versus the ERC. And I'm just using PPP as an example. The other programs are the same thing, but the PPP was an easier one to kind of play with. So under this particular example, this company had a PPP loan of $50,000 and they used it all as payroll initially, okay? Because that's the simplest thing to do is say, okay, let me just use it all in payroll. I don't have to figure out all these other things from a math perspective. So in January of 2021, they used $20,000. They had $20,000 in payroll, so they used PPP for $20,000. So they didn't have anything available for ERC wages. In February, they did 25, and they used up 25,000 of their PPP, and there's no ERC wages available. In March, they had $30,000 payroll, and they still had $5,000 worth of their PPP left over, but now it gave them $25,000 for use for their ERC, which would give them a credit of $17,500. Now, let's take a modification of that. Again, one thing I want to clarify is that if you've already sent in your forgiveness paperwork for your loan, then this is not going to apply because you've already set exactly how you paid for it. But if you haven't sent in paperwork to have your PPP forgiveness, then this could still apply. All right, so let's look again. So total payroll in January of 2021 was 20,000. You're going to use 20,000 of it for payroll. ERC wages at 0. Remember, I've got to use at least 60% for payroll because that was part of the PPP requirement. So that means I've got to use at least $30,000 for payroll. In Q2, I'm only going to use $10,000 from my PPP, so that gives me that $30,000. I've now got $15,000 left over to use for ERC wages. And in March, I've got all my wages available for ERC, which now means instead of having ERC wage base of $25,000, I've got a $45,000, which means under the exact same scenario with the exact same dollars, I'm getting 31,500 instead of 17,500. And that's all about just how you're classifying your PPP dollars. All right, so I'm going to go through just a couple of FAQs. Are employees required to withhold employee taxes? Certainly. Are self-employment individuals eligible? Again, no, unless you have employees. If a business decides to close or reduce hours, even though it was not required to, can they retain the credit? So they would not qualify under the closure process. But if you did drop below 50% or 80% for 2021, you could take advantage of the reduction of revenue. If an essential business shut down because the supply chain is shut down, can they claim the credit? So there's certain circumstances that you would have to look at in detail, and this is one you'd have to sit down with your accountant or who's ever filing your paperwork to decide whether or not it would apply. I will tell you restrictions on customers to stay at home doesn't qualify as a shutdown or partial shutdown. In other words, if your customers can't get out because the business, because the governor or the state or whatever said that nobody can go out, then that doesn't count. If a business is required to shut down or partial suspension, remember if we said that one of the restrictions was that if the government shuts down your business, then that's one way to qualify, even if you didn't reach the 50% or the 80%. So under those particular circumstances, you can only claim the credit during the period of shutdown or partial suspension. You can't claim it for any other period. You can't claim it for the next quarter or anything else. So that's a very limited. So you're really looking to try to find that 50% or the 80% rule. If you don't qualify for those, but you can qualify for the initial shutdown, you still may want to do it because there's still some money out there. It just won't be as much. Gross receipts we've already talked about. This is a case where we talked about if you were not in business in a particular quarter, how you count for the particular quarter. If you purchased a business, can you still take the ERC? Yes, and this applies both to a stock and asset acquisition. So that's a big deal. Under a stock, it obviously would make sense, but they also say it's even under an acquisition, an asset acquisition that would apply. So we also talked about gross receipts for tax-exempt organizations. So this is a big one here for some businesses. So if wages are paid to a related individual, the employee considered qualifying wages? No. So this is a long outstanding IRS thing about taking credits for family members. So if you have any wages that are paid to a child, grandchild, brother, sister, stepbrother, stepson, and a whole laundry list of people, it would not apply to the wages to be able to get credit for them. Okay. It also does not apply to an owner who's more than 50%. So if you're an owner and you have more than 50%, it would not apply to you either. But if you have an owner or a spouse, and the spouse is also included in number 10. If you're less than a 50% owner, which means you're not a majority owner, then it certainly feels like there's really confusion around this particular area, but it certainly looks like if you're less than a 50% owner, all of these would apply with the owner and spouse, and any relative wages would apply. It's just if you're a majority owner. All right, so how do you claim this credit? So for most of you, certainly for 2020, if you filed your 941, which most of you I'm sure you have, and same thing for 2021, you would have to file what we call a 941X, which is like an amended return, even though they call it an adjusted employees quarterly federal tax return. And this is basically a paper filed return. It has to be done within 3 years of the original due date. So you have time to file for this. So it's not like some of these other programs where it's going to end on December 31st or whatever else. You have time to apply for this program, but obviously the longer the wait, the longer it's going to take for you to get a refund, or longer for somebody in government to decide they're not going to do it anymore. So, but right now technically you have 3 years to file for it. If claiming in 2021 and you have not filed your 941, for some reason you haven't filed it for the first, second, or third quarter, then you can file it actually on your 941 that you most likely would file electronically. Otherwise, you'd have to file a 941X, which again would be an amended return, which is a paper filed. If you're a recovery startup business, you obviously can still file electronically for the fourth quarter. All right, so how long will it take? So this is the bad news. If you are filing electronically, you probably can expect 2 to 4 months. And again, this is a moving target because the IRS is not really giving any good examples. I just looked around on some of the CPA sites and some of the other tax accountant sites and finding from people who have submitted these things, and that's about how long they're taking. If you paper filed, they're taking anywhere between 6 and 9 months to get you a refund. So this is not a program where you turn it in and 4 days later you get your return. Now, you may be saying to yourself, God, that's a lot of trouble just to wait 9 months to get it back. But if you're getting $20 or $30 or $40,000 back, just look at it as a really cool bonus next year. So take advantage of it. So I've got some forms here. I'm not going to go through these. These are strictly just for a presentation so you can take a look at them. So I'm just going to kind of fly through these and not cover them, but they're for your references. Now, I'm just going to say, I'm not going to cover this whole program. I just want to say something about it since it is a program that you would also apply for it on the same program. In other words, if you're filing 941X for ERC and you also can qualify for the paid sick and family leave at credit, you would also apply for it on the same particular 941. So if you were doing this, then you certainly want to take advantage of it. And it also applies to self-employed individuals. It's not applied on the 941, but it is, if you're a self-employed, you would have to file it on your personal income tax return. But basically, if you paid your employees sick leave or family leave during any time between between March of 2020 up to December of 31st of this year, I'm sorry, September 31st of this year, then you could get a credit for this. I'm leaving these for your own information since they are pretty detailed as to how they qualify for it. But it basically means that if you had paid your employees because they stayed home because they were sick, etc. Now, if you didn't pay them, it's too late and it's not going to apply. But if for some reason you paid them and did not apply for this credit, you still can go back and claim these credits. And I'm not going to go through. So these are all the information. So that covers, Heather, if you want to go ahead and stop the recording, that kind of covers the ERC and just a real quick thing about the family